Welcome to the Maverick Ag 2.0 webinar series. Remember to like, share, subscribe, and if you are on YouTube, ring the bell. All episodes can also be found on maverickag.com. And a little sales pitch here. If you like what you're hearing on these webinar series, please feel free to go through the website, see our Maverick Ag 2.0 rebranding, as well as our launch of products, which has already started. There's a few up on the website, and will continue over the next few months. We've expanded our product line, obviously not just financial anymore, but into more equipment benchmarking, as well as legacy products, so succession, transition, and last but not least, into some debt mitigation, risk mitigation, and just business plans overall. So what we found was we were getting asked more and more for some of these non-financial products, and we wanted to be able to provide them not only to our current client mix, but to future clients. So if you are interested, have a look at the website and feel free to reach out. Also, Farmer Coach. Obviously, November, we start our new cohorts. By the time this gets released, it might be past that point, but please do reach out. We do take on waiting lists as well as enter you for our new cohorts as we release them. And with our broad range of cohorts now, I believe there's one that'll fit most farms out there. So what are we going to focus on today? So a couple of the past ones, I've done transition, I've done some marketing, I've done the built to sell one. Today, obviously, it's a few weeks past harvest now, and I'm starting to get emails from our insurers. And from that standpoint, I'm going to talk a little bit about risk mitigation today. And I didn't use the word insurance, even though I'm going to talk insurance as well, because most farmers out there hate the word insurance, and that's not necessarily what this is. So if you are watching from south of the border or Eastern Canada, I am going to focus a little bit on Western Canada when it comes to the insurance portion, but honestly, the first half of this, please stick around. It talks pretty broad range of risk mitigation, not just from an insurance standpoint, but from a farm standpoint. So that's where I kind of want to start, is that any risk mitigation that we go into here, even though we are a licensed insurance brokerage, and to give you upfront and bias, we do sell global ag risk insurance on the private insurance side, but that's not where I focus to start the process. And what I mean by that is most farms, insurance is a discussion that needs to be had every single year, and it is crucial. So if you are going uninsured, please run some numbers to identify what that looks like. But from our standpoint, there's a lot of other areas of risk mitigation that happen internally before you ever actually go and try to transfer risk out of the farm. So the first one, obviously on the financial side, and I don't want to sound like the recovering accountant again, but cost of production. Biggest risk on the farm right now, as we're seeing it, is the cost of production. I mean, we've seen them fly up. From when I started farming, it was 100 to 150. And then when I started MNP, it was moving into that 300 to 400. And to tell you the truth, I mean, most provinces today are approaching 600. And based on that, and we've talked about it on the marketing one prior, that's the highest risk on farms today, is just the cost of production. And with the cost of inputs going to 2025, as well as the cost of machinery and upgrades and carbon tax and everything else that's getting thrown at farms today, that still is the top risk. So what I've seen, even from the insurance side, is those farms that can control their cost of production internally from a management perspective also are considerably more insurable and have considerably less chance of loss, even in drought years or even in years where commodity prices are down. So from a farm perspective, if you want the easiest way to actually control the risk mitigation on your farm, look at cost of production. And by cost of production, I mean per acre, per commodity, per bushel. We've talked about all these things in the past, and yet the stats across Canadian and US agriculture continue to get worse. They're not getting better. So guys are getting involved with more complex discussions every single day, and more decision making, more operations. It's harder to get things in the ground. It's hard to get them out, weather. And part that's getting lost is just the planning stages. And that, to me, is the most crucial standpoint. And that's not just because I'm biased, because I am a CFO, but it's based on, if you don't plan, it doesn't matter if you get the crop in the ground or get it out, a bad plan is going to affect you just as much. Second area, worst case scenario. And I know lots of farms know their numbers, but I know lots of farms don't actually know what the worst case scenario is. And what I mean by that is, whether it's with insurance in or out, what is that number where Ritchie Brothers is showing up on your front lawn? And it's a bad discussion, and it's a negative discussion, but it's a discussion that has to happen every year, is that we need to know, from a consulting standpoint as well as an insurance standpoint, what's the most you're willing to lose before you start feeling it? And that's how we base most of our plans around it. It's not around the premium cost, and it's not around the coverage levels. It's around how much can you afford to lose in your circumstance. And this is a farm by farm circumstance. And that's part of the I hate about selling crop insurance rather than P&C insurance, which is just your general insurance, is that crop insurance is an annual discussion and it's different for every single farm. Where P&C, I mean, you can create large scale policies for large farms, which is something we're working on, as well as just an ordinary policy for an ordinary size farm. And those are pretty relevant across the entire industry. I mean, some of the liability amounts might change and the equipment amounts might change, but the policy itself is consistent. Where on a farm by farm basis, when I create insurance products and group products and stack products, it's literally farm by farm. So the time consumption it takes to actually put a plan in place is more significant. Let's put it that way. And then the third one from a financial standpoint is you got to know your balance sheet. And it sounds funny because most guys, when they're talking insurance, all they talk is income statement. What are my costs? What can I, how much can I cover? Blah, blah, blah. The main aspect is that your balance sheet also drives these discussions. And what I mean by that is from a working capital standpoint, how much cash can you afford to lose before you lose some of your decision making? If you think you can take $100 an acre loss and all of a sudden next year, because you don't have the cash flow in the bank, you have to sell at a lower price because you need cash, or you can't buy your inputs at a better margin, that's a detrimental effect that we should have taken into account the year before. So your liquidity position and your cash flow position actually matters when we're talking about insurance for this year because it has an effect on the future. The other one is debt service. I mean, it's pretty much the top ratio that we look at on our farm as well as for our consulting clients is the debt service ratio. Is how much do you have to make in EBITDA, which is earnings before interest, taxes, depreciation, call it cash earnings, to pay your debt. So when you're looking at insurance, do you actually know what insurance number you have to get to in order to make sure your cash flow is consistent enough that you don't breach a covenant on your bank? And don't get me wrong, 1 year, breach covenant, move forward, you get your hand slapped. I get it. But on a 3-year average, and I'm looking at areas in this province that have had 6 to 7 years of drought, that's a considerable discussion we have to have is what do you need to insure to make sure that you still repay on your debts? Because it's one thing to lose money. It's another thing to have your bank knocking at your door. And then obviously the third one is, what's your situation? And I mean, this is the one where I have the largest fights usually is a retiring farmer often thinks, I can save a few bucks here on insurance. Why do I do it? Well, that's your retirement fund. And from a standpoint of a guy who doesn't farm, but owns portions of a farm, my retirement fund is what I have to live off of for the next 20, 30 years once I hit that age. It's something I don't want to lose. So no different than I work in an office building with a financial advisor, and when the markets drop, he gets multiple phone calls. Well, it's no different. When you have a bad year, it's pulling directly out of your retirement fund, where for a minimal, and I do say minimal because insurance is not one of the top 5 costs on your income statement. For a minimal cost, you can secure your retirement, and that's important. And then on the other side of the coin, from a new entrant perspective, as a new entrant, how much can I afford to lose before it starts hitting me to a fact that I can't grow? Or maybe I'm going to have trouble paying bills and it's early in my career. Like, there's a whole bunch of discussions that need to happen outside of that. Now, the part that most don't take into account, and I look at this as well, is from an operational standpoint, is there is such thing as operational risk management. And what I mean by that is you still got to get the crop in and out. Most insurance products only kick in once the crop's in the ground or once you've spent on the inputs or, all those items. So from a human resources standpoint, what's your team look like? Are we short on labor? Are you going to have trouble getting the crop in? If something were to happen and we talk about it, from a key man issue, if you're not around, does that crop get put in? Because that's a significant risk on the farm if you're just a one-man band. So there's that point. The other one is economic units. Like, I can insure gross margin. I can insure yields. I can insure prices. There's a whole bunch of things above the gross margin number that I can insure. And obviously AgriStability takes into a few below the margin. But the one thing that none of the programs take into effect is your actual fixed costs. So what I mean by that is your equipment costs, your land costs, your overhead costs, all those items, those can't be insured. And what happens usually is that a lot of insurance products, including our own, like to say that I can insure you a net income of this. And it's not true. Same as AgriStability. I can insure you to a yield, or I can insure you to a margin number. What you do with the fixed cost below that's on you. So if I have you bulletproof to start the year and you go out and redo your whole equipment line and hire 5 additional employees and drive your fixed costs up, there's no insurance product that actually pays you out for that. So those have detrimental effects that we need to have discussions on as well. And then obviously the conditions. And this, you can call it a qualitative discussion when it comes to insurance, but it's also an operational discussion of, are we in year 7 of a drought? Are the commodity markets still depressed? Is there geopolitical factors that we're literally sitting on, such as 2 wars, that may have an effect on operations next year? So, I mean, all of those aspects affect your risk management profile on the farm. So from that standpoint, I haven't even talked insurance yet, and I've covered off a significant amount of items that you want to have discussions on and strategies and plans before we ever get into the transfer. Now, for those that aren't in Western Canada, some of this may not apply, but a lot of this will, because your products aren't far off what we have. And the big one for me is, and I'm going to tell a story that I'm not totally proud of, but when I started at MNP in 2006, I got a good chance to mentor under one of the farm income program leads of the firm. And I'll give you a shout out, Mr. Furster, Shay Furster. And he's still involved with the firm, not as much on the farm income program side, but he was the one that actually pushed me a little bit. And what he did is he posed the question, and I'd been farming for 10 years by that point. And he asked me the question of, do you actually know how crop insurance works? I said, oh, for sure. I mean, Dad bought it, Grandpa bought it, insures a yield, get this. No, he says, have you actually read the crop insurance manual? And that was the first hit of what's led me down the career path I have. And not only just on the insurance side, but on the risk side and on the financial side of, I had no idea, and I'd been farming for 10 years. And that doesn't say much for me, but it also is that aha moment I've talked about in the past. And once I got through the manual, I realized that I didn't know anything about how those insurance products worked. And from that point forward, I've made it not my goal, but I've made it a process to make sure that I understood every single product, up into not only GARS, but my competitors in the market, as well as the government programs. Because I've said it before, and I say it again, is AgriStability to me is still one of the strongest programs out there. And I'll give you a few reasons why here, but it's those due diligence that really changed some of the mindset of a lot of farms I've worked with, as well as my own. So the main aspect that I love is that a lot of farms like to go on social media, and they like to go to the coffee shop and complain about the insurance products. There's not enough coverage. They're too expensive. The premium's too high. Well, we need to have a reality check. And what I mean by that is, by coming out in public and saying that, you might as well just tell the farmers across the coffee row from you that I'm a shitty farmer. And I'm sorry, guys. Yes, there's been areas with drought year over year over year, and they get a pass. But by saying that AgriStability or crop insurance or the private insurers don't cover what you need, that is literally saying that you haven't grown enough grain in the past and your fixed costs are too high, that insurance no longer works for you. And I laugh because AgriStability gets torn apart in the media, and yet it's the strongest program out there, and it's 100% based on historical margins, which means your numbers, your margins. And same as the private insurance, the quotes are based on your chance of profit this year, as well as your historical margins. And crop insurance is based on your historical yields and how many claims you've had and how many dollars you've claimed in comparison to how many premium dollars you paid. Like, everybody complains about the new premium numbers, and I don't know the back end on that yet, but I do know that it's based on dollars out versus dollars in. So if your premium's jacked, it means you've taken a lot of money out of crop insurance. So a lot of these guys who like to lie about their yields at Coffee Row and don't tell guys are quite open to say that, no, I've got really shitty coverage. Well, you're essentially telling them that you haven't grown a crop. So that's the first one. The second one is, you got to realize, guys, the government programs are highly subsidized. The taxpayers are paying a significant amount. So when we have discussions on supply managed versus grain and subsidies in the US versus Canada, sit down and do the math of what you're actually subsidized on your crop insurance between AgriStability and between provincial crop insurance. Grain producers get a significant amount of subsidies, and we still like to complain that we get nothing. So know the programs. That's, I guess, where I'm starting. And then the last one is, I beg guys to start looking at crop insurance as a fixed cost. And what I mean by that is, no, I don't want you to escalate and buy $50 coverage from me and blah, blah, blah. I want you to put a line item there that is there and it's solid and it is fixed, because every year I have these discussions with guys, and I've got guys who've gone uninsured in the past, and there's some big farms that have decided to go uninsured. It's ludicrous for the cost that you're paying on that versus the cost that you would pay for a fungicide or a cost you'd pay for additional fertilizer. Insurance, it's not sexy. It's not a big combine on your front lawn. You can't see it grow. It is one of the most important costs on your farm because it allows you to keep farming. So keep those in mind. From there, I'm going to walk into the programs a little bit here. Obviously, I'm at 15 and I don't want to go too long, but straightforward, the programs, I'm still an advocate for agri-stability. And what I mean by that is it's based on your historical margins. It takes into account your inputs. So the mindset side is there. I don't like programs where you literally can stop farming in June because it didn't rain and pull back and make every bad decision there is, because you know that insurance is going to cover you on the yield decrease and you just don't have to spend the money. I'd rather a program pay you to spend the money, try to save the crop, put in fertilizer for next year, do everything right. Because when you start doing stuff wrong, I find it changes the mindset going forward, and it turns you into a bad manager for multiple years. It's not just 1 year just because, it's a multiple year factor. So I like the mindset of the margin insurance, and so I like agri-stability. The other point is that agri-stability covers more than just inputs. So in your allowable expenses, you have wages, you have freight, you have a whole bunch of other items that we've seen go up in cost. So you're getting insured for the labor increases. I mean, per hours that we pay guys from 10 years ago to today, drastically different. The other one is the Olympic average. If you get stung, that doesn't mean your margin goes down in year one. In fact, with other insurance products stacked in, agri-stability probably lasts you a good 4 or 5 years into droughts and into down cycles, because the first couple of years, your other insurance products are going to pay, which will hold your margin up. And then you start using your agri-stability past that. So there is multiple ways that I like the program. Obviously, guys like to call it the accountant program because, yes, it's costly to file and it's hard to file. But for me, I think it's the number one program. Moving forward, tell me what your farm risks are. And I mean, from that standpoint is, I don't care if you go private or government. I don't care if you go yield or margin. All of the programs going forward are based on your needs. So each farm is individual. So if you're in year 7 of a drought, yes, yield is probably your number one issue. We're going to have discussions on, obviously, crop insurance. Can you even get private insurance? Because there's certain areas that are too high a risk, which I agree, because as an insurer, you're not going to insure someone who's burnt their house down 5 times in a row. Doesn't matter if it's food security or not. So being that provincial insurance is stop loss insurance, you're going to get insured for something. So obviously there's certain farms where crop insurance is the only option, and that's fine. Other farms, when we start talking about, what are your processes? Are you a farm that's going to go for it every year? Are you going to put the inputs in? Are you going to top dress? Are you going to do multiple applications? Are you going to market hard? Are you going to be very risk? Is your cost of production too high? Because one of the main ways that I utilize private insurance is for guys whose costs are so high that crop insurance even is not high enough to get them out of that Ritchie Brothers sale. And so if you still got $100 to $150 on the table, I'm looking at other insurance products, whether it's AGI3, whether it's global ag risk insurance, to bring up your coverage level so that we can actually save you. And don't get me wrong, there's still going to be a level. And I know some of the accounting firms look at these levels and say, well, the probability of landing right at that crop insurance line at 80% is very high. And none of these programs save you there, so you shouldn't buy any. Well, that's fine. But as we've seen over the last 5 years, landing at 80%, some guys wish. So we've landed below that for the last few years, which shows proof of concept because all programs have paid. Now, on top of that, we also said that prices, a price decline of 30, 40%, that's unheard of. That's not going to happen. Well, we just saw price declines in the last few years. What goes up must come down. So from that standpoint, we're seeing all those things that I hear a lot of accounting firms and a lot of individuals say, it just won't happen. Yeah, it does. And it did. So from that standpoint, when we go back, I mean, we'll calculate, would you have been in a payment this year, over the past 5 to 10? Guys' eyes go wide because they realize how much money is left on the table because they got talked out of it. And I mean, that's why to sell, to do the private insurance side, we have to be CABE certified, which means I've gone through multiple courses, because the E&O and the insurance on that is incredible. If I talk you out of a program that would have paid you a couple $1,000,000. So from that standpoint, you need to look bigger. So it's not just about premium. And as an accountant, don't get me wrong, I was no different. I focused on premium. I focused on low cost. We got to do this to risk secure. I mean, accounting's very black and white. I get to play in the gray a lot today. And so from that standpoint, I'm looking at all the areas of risk that have an effect. Now, do I cut crop insurance out of many of my plans? No. Why? Because it's subsidized. It's a cheap product. It covers yield, which to me is still the number one risk. And it does a lot of things that are positive. So from that standpoint, most of my stack is based on crop insurance stays in. Now, is it the best premium from a 70 to 80%? Maybe not. Maybe that's where I throw in an AGI 3, or do you have good enough insurance coverage and yield levels that maybe we double up just on yield at the top? I mean, those are all discussions you need to have. And then when you start talking margin, it's okay, how aggressive are you going to get on contracting? Because between you and me, most guys should have been 80% sold on canola 7 months ago. And guys are going to say, well, I didn't grow it. That would have cost me. Well, not if you were insured with the right programs. So from that standpoint, you would have got $15 to $16 canola for this year's crop. It would have already been hauled to the elevators, most likely. You would have had the cash in your hand. The operating lines would have been down. I mean, those are discussions you have to have. It's not just yield. And farms likes to talk in bushels and yield because it's sexy and it's a good discussion at the coffee row. That's not reality. Reality is margin. What's the revenue figure? So from that standpoint, and there is going to be areas where private insurance doesn't work. I'm not gullible enough to believe I can insure every farm, nor would, from a consulting standpoint, I couldn't do it. So morally, from that standpoint, there is going to be areas that can't utilize stacks and other insurance products, but a lot of the province can, and a lot of the province need to start running those numbers. So that would be my big one. And I mean, I'm going to run a webinar probably in the future here where I get representatives from all the private insurance and SCIC on and have them give their speech of what their product does and the benefits and the negatives, and have a real discussion. Because don't get me wrong, if you're getting your advice from X or Twitter, stop, because that's not the place to actually get advice for this stuff. Have discussions, know your numbers, because every farm's different. Just because I can't insure farm ABC doesn't mean I can't insure DEF. Like it is a year by year, farm by farm analysis that needs to be done. So in saying that, I won't go too much further, but Maverick Ag, obviously another pitch. We run these programs for you. Obviously, we're a global ag risk distributor, so reach out to maverickag.com and we can get you a quote. The process is quite simple on all the products. Obviously, the online stuff is a little more simplistic, but with the good advisors in your corner, getting financial releases signed and in and getting quotes out. And don't get me wrong, you're going to start hearing from the advisors here in the next couple of months, because in order to get insurance and get the companies enough coverage that they can insure enough individuals and farms across Western Canada, they need to get their numbers into the insurers early. So if you're wondering why guys are reaching out in your harvest hangover in November, December, it's more or less to get the coverage that farms need before January. And then obviously January to May, you're going to start selling, but make sure that you have good qualified advisors that run the numbers through the calculators that they have, whether it's MNP, whether it's your GARS advisor, it doesn't matter. You need to see the numbers and the data and then start talking the qualitative, because there is a whole bunch of factors that come into play. So again, reach out, like, share, subscribe, keep watching maverickag.com for some of these webinars. Thanks for listening.